Hi everyone, I'm James Harte from littlefishfx.com and thank you for joining me for this week's live market analysis, where we're actually going to look at some key levels in the major FX markets ahead of tonight's FOMC rate decision. So as ever with these weekly analysis sessions, what we're doing is looking at the main currency markets, talking about the key fundamental developments affecting each currency, and then looking at the technical outlook for the week ahead, identifying bias and trading opportunities. So as ever, if you have any questions during the session, please just write them in the chat function and we'll stop periodically to answer them. Okay, so kicking off first of all then, as ever, with the US dollar. And obviously the main story with the US dollar is tonight's FOMC rate decision. Now, we've had a lot of hawkish expectation building in the market in recent weeks on the back of various hawkish comments from Fed members and also those hawkish April FOMC minutes, which pointed to a June rate hike. But all of this was sharply undone in the wake of that dismal May non-farm payrolls report, which saw just 38,000 jobs added in May, as opposed to the expected 160,000. So on the back of that report, we've seen a significant downshift in US rate hike expectations and also a subsequent dialing back of the hawkish language by Fed Chair Yellen. So expectations for the meeting tonight then, a June hike is seen as firmly off the table, but the real crux of this meeting is going to be whether or not the Fed signals that a hike in the coming months is still seen as appropriate, such as they viewed it in the April FOMC minutes. So with June off the table, July pricing is starting to weaken, and those that are still looking for a rate hike in the coming months are now looking at September as the next strong contender, and December is actually the only date which is actually priced in. So really the main takeaway with tonight's event is going to be whether the Fed can assure USD bulls that a rate hike is still coming in the next few months. If not, then we can expect quite a sharp US dollar unwind. Now, a big variable that markets are considering within this current dynamic is actually the issue of Brexit. With so much investor uncertainty ahead of the UK referendum on June 23rd, the Fed are likely to avoid raising rates in the wake of such an event due to the potential volatility and instability that we might witness. So a big part of this puzzle remains to be seen. If Brexit is avoided and uncertainty dissipates, then this no doubt creates a more stable environment for the Fed to raise in. But if Brexit does occur and subsequently we see damage to the UK and Eurozone economies, then the Fed is likely to avoid raising in this environment. So certainly the outcome of that referendum will be highly important and keenly watched by markets. Now, tonight we're also going to have updated forecasts, so updated growth and inflation forecasts. We recently saw the ECB revising their growth and inflation forecasts higher, so it's going to be interesting to see what happens here. Obviously, oil is continuing to forge higher prices, which is expected to spill over into higher inflation going forward. And US inflation has been steadily improving over the last 6 months, so it could be that we see some upward revision to those forecasts. GDP growth, however, has been trending lower over the same period. So definitely going to be keeping an eye on developments with those forecasts and how they're updated. So some big areas of interest in tonight's meeting. And again, to summarize, the key is essentially whether the Fed signals that a hike is still likely in the coming months. And as such, we see July, August, September pricing improve, or whether the Fed avoids this. And as such, we see December pricing weakening. So looking at the technical charts then, we can see that the US dollar did indeed find support at around that 93.90s mark last week. So for those of you who were in the session last week, you'll remember that I highlighted this level as likely being strong support, giving us a potential inverse head and shoulders. So you can see that we actually ran a little bit beyond that level. We pushed below it, but we actually tested that really neat inverse head and shoulders level at the 93.60 level. We held there, found support and bounced. So we actually got our inverse head and shoulders pattern in play. Now we've currently stalled at a retest of the bearish trend line. So this is key territory for the dollar index at the moment. This short-term resistance is the bearish trend line, which we're retesting. Okay, if we hold here, we can expect a rotation lower. But beyond this bearish trend line, if we break out above here, the next key level that I'll be looking at for the dollar index, which will signal a breakout higher, will be a break above the current 95.90s high. Okay, so that high that we made into the start of June, to the end of May rather, when we first broke that bearish trend line, since turned out to be a false break, price traded low. We've now retested these prior lows, which gave us good support. We bounced, and so the key now is going to be whether or not we can get back above that level. Okay, if we can get back above there, that's going to signal a strong breakout for me, and the levels that I'll be targeting next will be initially the 50% retracement from the December highs at around this 95.50s level. You can see we also have good structural resistance there, and then good structural resistance at this level rather. We've got this prior low, and this swing high. So we can go ahead and mark that level in as being one to keep an eye on if price does indeed trade back up there. So beyond there, then the next clear target, if we do indeed move higher, will be up to the 61.8% retracement from that same high at around the 97.20s mark. And again, you can see this is another really strong structural level. So we've got this previous ledge of broken lows, these swing highs. So this is another really clear target for the dollar index if we move up. So we've got some key levels to watch. Obviously, the main catalyst is, of course, tonight's meeting. If tonight's meeting is perceived as dovish, then obviously we're sitting right on top of this major support zone in the dollar index. So if tonight's meeting fails to provide assurance to US dollar bulls that a hike is coming in the next few months, then we are likely to see a rotation lower. I think for this support to give way, though, we're going to need some pretty significant downshift in tone by the Fed. Otherwise, I think if it's more a case of simply a muted statement and the Fed playing their cards close to their chest, then I doubt that we'll actually see a break of that level. And what we're more likely to see is simply a rotation down into it, a test, and then a bounce, which would keep us within this current range of 93 to 96. So for us to actually break that level, I think we'd need to see a really significant shift in tone by the Fed. Otherwise, if the Fed does still keep a rate hike on the table in the next few months, so if we do get a little bit of a hawkish surprise, then we're likely to see that light of fire under the dollar index, and then we can start to challenge this 95.90s level, which is the key breakout zone. So again, if the statement is a little bit muted, if the event is a little bit muted, then we're likely just to continue to rotate within this range for now, ultimately hanging out in the bottom half of this much bigger range from the 91.90 low to around the 100 mark high. So those are the levels I'm watching for the dollar index. A break of 95.90s to the top side, signaling the breakout. And then, of course, we have this big low at around 91.90 to 93, signaling the downside break. So let's take a look now at the main currency pairs and see what setups we have there. Okay, so kicking off with the euro then, first of all. Euro has been under a lot of pressure this week, actually, suffering again from investor uncertainty surrounding the issue of Brexit. Okay, if the UK does leave the EU, markets are expecting the EU to become vulnerable with the stability of the entire EU project thrown into question, but also the likely damage to occur from separating out the UK markets. So the euro has traded lower from where we were last week. So last week, we were around this level here. We just broken higher on the back of those NFP results. We traded up and we were retesting the underside of that broken bullish trend line. And essentially, we identified that we had this clear head and shoulders pattern. So whilst that level hold, we were expecting that was going to be a right shoulder and we were going to rotate lower. Now, we were actually scoping out some higher levels in the euro last week. So we were looking initially at this level just above the current high at around the 114.26. And then beyond there, the 115.27 and 115.98 highs. And those levels could still come into play, okay? If we get a dovish FOMC tonight, then we could quickly find those levels and we could get the top side break. So the top side break for me will be a break above this 14.26 level. Okay, if we just zoom out, and again, if I change the color of that level so you can just see it clearly. So this 1426 level has been a really important pivot for the euro over the last 15-18 months. Okay, so each time we've tested that level, we've seen a subsequent bearish reversal. So this is a really important line in the sand for the euro, and if we get above there on the back of tonight's meeting, then that could signal a breakout to higher levels. Now to the downside, if we do trade lower, either on the back of tonight's meeting or in coming sessions, then the downside break level that I'm watching is actually going to be initially this 110.95 to 110.60 level. Okay, so this little band here where we have these prior lows. So these prior lows, the 50% retracement from the November 2015 lows, also this rising trend line support, and obviously the current low from the last 2 weeks. So if price does break down below that level and we get a break below there, then I'll be looking for a move targeting this 108.24 level. Okay, so this was another major zone in the euro over the last 18 months. You can see we found significant support and resistance there along the way. So I'm expecting that will be something of a magnet to price as we trade down. And obviously we'll also have then a symmetry move in play with the euro, with this ABCD completing just ahead of that level. So if we get a move down to that 108 level, I'm expecting that to provide decent support. So looking to use a break of this level, targeting a move down into 108. So there's around 200 pips worth of room to play for there. So if we do get a downside break there, then we have plenty of space to target. We'll actually have some interim support at this level, which we'll need to keep an eye on. You can see this raft of previous highs lines up with the 61.8% retracement from those November 2015 lows. So we'll keep an eye on price action as we trade into that. If we see any interim bounce from there, I'd expect a retest of this level to provide good support. So again, that level is the 110.60 to 110.60 to 110.11. So a 40 pip band there of support, which if broken signals a likely downside break. So we could get a move that looks something like this, or alternatively a bounce from here. But again, ultimately expecting that the break of this level signals a move down into this 108 region, and then I'll be looking to use this level, a retest of this level, as resistance to set shorts. If we do bounce, we might just blow straight through it and trade down. Okay, so that will be the downside play, and then to the top side, it's a break of this 114.26 level, targeting 115.27 and 115.98. So some nice clear lines in the sand there for the euro. Obviously, the last few months we've been pretty much range bound in this area. You can see we've been rotating between the 111 zone and the 115 zone, pretty directionless, chopping around in either direction. So on the back of tonight's FOMC rate decision and what it signals for the Fed's rate path or view of their rate path over the coming months and the subsequent market expectations and anticipation, then we could see some more directional moves on the back of that. Okay, looking to cable then, sterling has been a far more straightforward chart. Okay, so last week we were chopping around in this region here. We were just below the 147 highs and we were just above the 143 lows. Okay, and you recall last week that I actually noted these two levels as being the lines in the sand. So the top side break was going to be a break of that 147 level, and the downside break, and I've kept this line on the chart from last week, was going to be a break of this 143.40s level. So we clearly had the contracting triangle formation here with these converging trend lines, and then we also had key structural resistance lining up with that bearish trend line and key structural support lining up with that bullish trend line. So the play was either to play a breakout to the top side or a breakout to the downside, and you can see that we got quite a nice clear breakdown. Now, I wasn't actually expecting that we were going to see such a strong directional move until after the referendum, though I did note that if either campaign rather started to see a really clear majority building in terms of these polling results, then we could start to see some bias and some directional skew in the market. And obviously the big news in cable this week has been a growing support, a growing majority for the Vote Leave campaign. So for those in favour of the UK leaving the EU. So recent polling results have started show a building of the majority there. And so obviously sterling has been hammered lower on the back of those results. So we got the break of that 143.40s structural support. We got the break of that rising trend line. And then we also got this lovely little textbook play, which is a setup that I really like to focus on, keep an eye out for, which is you can see that we broke down through that rising trend line, stalled out, traded back up and retested the underside of the broken trend line. So these throwback trades are a really great setup to keep an eye out for. So we had the test of the broken rising trend line at 143.12, and so the target on this move is 140.58. So obviously this move is still in play at the moment. We haven't quite reached our target. Now if we do get down to this 140.55 level, this again is obviously big support for cable. You can see this was the shoulder area of this previous inverse head and shoulders pattern, and you can see there's a whole ledge of previous lows here. So we know there's a lot of demand likely still there. So if price does trade down to that level, we can expect support. And you can see indeed already that we've essentially tested this band now and we're already stalled out. So whilst we hold above this zone, the 40, 55 to 41 area, we can really expect a rotation higher, okay? And obviously the rotation higher is likely to be capped by this 43.40s area. So these two big broken lows coming in with the retest of the underside of that broken bullish trend line. So some really nice clear levels to look at in cable. Obviously beyond there we can start to think about a move down to these lows, but a move of that magnitude is likely to either see is likely to occur on the back of the referendum. Okay, I'm not expecting tonight's FOMC decision to have too much sway in the sterling dollar at the market at the moment, which is predominantly driven simply by these Brexit polling results. So definitely need to keep an eye on these polling results as they continue to come in ahead of the referendum next week. Okay, so the dollar yen then, and the dollar yen has been another quite straightforward chart. So we've seen Japanese yen safe haven demand kicking in over recent sessions, which coupled with deteriorating US rate hike expectations has seen this steady sell-off. So the level we were at last week when we discussed this chart, we were around this zone here, okay? So we'd just broken down below that area which we'd marked as key support. So the NFPs had blown that level out of the water. We'd since traded back up, retested the underside of that broken support, and you can see that we stalled there and actually found resistance. So I was expecting that we could see a deeper inverse head and shoulders pattern in line with the structure that we were seeing on the dollar index chart. However, that didn't actually materialize, okay? So we found resistance at that 107.91 level, and we've since traded lower, and now we're testing the year-to-date lows. So what we've potentially got now is a big double bottom, okay? So if the dollar yen is going to break higher from here, it's going to be from this double bottom mark. Now, if we do get a break higher from here, the level in which I'd be looking to engage is actually a break above this short-term bull bear line to this short-term price pivot at the 107.91, okay? So you can see we found really strong support there earlier in the year. We then broke down below that level on the back of the NFPs, traded up last week, retested it, and that broken support was found then to have turned to resistance. So if we now get back above that level, that's going to signal a breakout for me, and we can look for longs there, targeting a move then up to this 110 level, so roughly 200 to 300 pips above market. So that's going to be the level that I'll be watching. Now, obviously, that move is likely to come if we get any hawkish surprises from tonight's FOMC meeting. Obviously, if the meeting is more of a dovish affair, then the level that everyone's going to be watching is going to be this 105.50s low, so the year-to-date lows. And we're likely to see that level broken down if we do get a dovish skew from tonight's meeting. So those are the levels I'm looking at with the dollar yen. A break of 105.50s signaling the downside break, but a break above this 107.90s level signaling the topside break, in which we'll be targeting a move back up to this really important pivot at the 110.99. So we'll basically call that 111. At the 111 mark. So that's going to be the level I'll be watching as a target for a break of this 107.90s. Okay, the dollar Swiss then. So the dollar Swiss has been a great chart recently. It's given us some great trades. Last week, we were in the midst of this total collapse. Okay, so we had this parabolic move lower in the dollar Swiss. We were actually calling for a continuation lower on the break of this support level. And then the level that we were actually looking for as the target on this move was this 95.85 level. So we were looking for this to provide support. And then the move that we were looking for, you can see I've actually left these lines on from last week. So we were looking for a bounce from that level to trade up and retest the underside of this key broken support at the 96.68 level. So you can see this is a really key level for the dollar Swiss. We had support, a break, resistance, a break, support, a break, support, a break. So I was expecting if we traded back up, we were going to find resistance there. And you can see that's currently the level we're at. We traded back up, tested that level, found resistance, and we've since started to sell off, okay? So this is a really straightforward chart. We've had this big period of expansion here with the collapse lower. We're now seeing a period of consolidation and correction. And so ultimately, I'm expecting this to provide a subsequent further expansion. So we've got the resistance at this broken support level. We've got the bearish trendline resistance just ahead. So I'm still expecting that whilst we hold below this 96.70s level, that we're going to break lower. And obviously the target on that break will be a move down into 94.90, so the 95 mark to the 94.40s mark, which is obviously the year-to-date low, which was that big double bottom in the Swissy, which provided that big ramp higher, okay? So whilst we hold below 96.70, looking for a rotation down into the 95/94.50s mark. If we do get above this level, okay, if we do get some hawkish surprise from tonight's FOMC meeting, then I'd expect that the move above this 107.9, the 196.70 level rather, and the break of this bearish trendline resistance would see price rotate higher up back into this 97.80s level, okay? So they're the key levels that I'm looking at in the dollar Swiss. So holding below 97, target to move down into 95, above 97, target to move up into this 98 region. Loonie then, okay, a similar story in the Loonie. Last week we were also caught in that decline and we were looking for a similar situation, a brief continuation lower before we were likely to find support and get a bounce. Now the level that we actually marked out as support on this chart, I'll just bring this line down because it's better color, was actually this 126.20s level, okay? So we had some previous structure here with these lows and this rejection bar, and then we also had the 78.6% retracement from the year-to-date lows. So I was expecting that we were going to trade down, test that level and get a bounce. Now you can see we actually bounced ahead of that level, and the technical structure which gave us a bounce was the retest of this broken bearish trend line. So you can see we had this clear bearish trend line in play. We broke out above it when we got the break last month of that inverse head and shoulders pattern. So that was another great trade that we highlighted. We subsequently failed at the initial target, traded lower. We've now retested that broken bearish trend line and bounced. So quite a key development there. The rejection of that broken bearish trend line signals that we might actually continue to move higher. Now, obviously, the FOMC tonight is going to be a major catalyst in the medium term for this pair. So if we do fail to the top side, the area which I'd expect to hold as resistance is going to be this band here. So the 129 to 129.40s level is likely to provide strong resistance. We've got this ledge of broken lows and previous swing highs, now broken lows again. So if we trade back up there, we could see a failure. This could be a good area to set shorts. To the downside then, the downside the downside break is going to be the break of this 126.20s level. So if I just zoom out here for a moment, so you can see the bullish trend line from the 2014 lows comes in at that 126.20s level. We also have the 78.6% retracement from year-to-date lows. So if we get a break of this level, then I'll be targeting a move down into those year-to-date lows of 124.60s. So roughly 150 pips worth of room there. So this is a really good chart to keep an eye on. We've got some really clear levels. Now to the top side, the level which I'd be looking to use for the bullish breakout would actually be this 131.90 high, okay? I'm expecting a test of this 129.40 129 to 129.40s level to provide good resistance. If we get back above there, nothing is going to be confirmed to the top side for me until we get a break of this level, okay? So this was the area that we broke out to when we traded above the neckline of that inverse head and shoulders. We failed there on the first test. So if we do get a break of that level, then what we could see set up is actually an ABCD move here. So a target on the break of that level would actually be a move up into this 133.80s region. So won't be looking to engage on that until we get back above this level. And really, again, if we do get more of a muted meeting tonight, then I'm not expecting really that we break either of these levels. And really, we're just likely to stay range bound between the 129 to 129.40s resistance at this zone and this current low at around the 126.50 region, with obviously the 126.20 level providing the 78.6% retracement. So this is likely to be the area that we range in if tonight's meeting does provide a muted response. Okay, moving on to the Aussie then, and we had another really another really clear-cut move in the Aussie, which for those of you who were in the last session, hopefully you were able to capitalize on. We called this, and this was a great trade. So last week, the Aussie was just above this 73.80 level, and we noted this 74.97 region as being really strong resistance. So we had this ledge of prior broken lows providing key structural resistance. We also had confluence with the 50% retracement from the current year-to-date highs, and then we also had this lovely symmetry confluence, okay? So the retracement, so the current retracement was of equal length to that last push into highs. So really good technical confluence there between the symmetry level, the structural resistance, and the Fibonacci level. So we traded up, tested that level, and reversed lower. And you'll remember that the target that I actually called on that trade was just a retest of this 73.40 to 73.80 level. You see, this was a really key level for the Aussie. We had these prior big highs last year in the Aussie, broke out above them. We've since traded through them. And so I was expecting that if we traded back down to that level, we were likely to find some support there. So you can see that's currently where we're stalled at. We traded down into that 73.40 to 73.80 region, and we're currently bouncing. So the big question now is where next for the Aussie? And last week's analysis still stands, okay? So last week I was talking about these ABCD moves, which we could see complete. So if we stall at the current level, which if the move stalled at the current level, which for now it has, then I was expecting that we could see a push higher in the Aussie. So we could get an ABCD move higher where the CD leg would be of equal length to this initial AB leg. So if we do see a move higher from current levels, that would complete into the 78.6% retracement level of the current year-to-date highs. So that would be the target for that move. Now, obviously, if we do break out to the top side and get above this current 75 level, then I'll be looking to use this level as support, okay? If tonight's FOMC meeting does provide more of a dovish skew, if USD bulls don't get the reassurance they're looking for that a trade hike is still in the rate hike rather is still in the offing in the coming months, then this is going to be the top side break level for me in the Aussie. So a break of this 75 level is likely to signal continued upside, and we can look to use that level as support. Now to the downside then, we've got some interesting levels. So the initial level we'll be looking at would be a minor ABCD from current levels. So we've had this initial pullback, we're stalling at the level which we not marked out. If we then retrace lower from there, the move would complete into this 72.50s level rather. You can see that we had previous strong resistance there. That was the last ledge of resistance in the Aussie before we got that big breakout back in February of this year. So if we trade down into that level in this ABCD fashion, then that could signal a level of strong support from which we could correct higher. Now the downside break in the Aussie for me is going to come at a break of the current 71.40s lows, okay? So if we do break down through that low, if we get that nice slingshot move, then that could signal the likelihood of completing this much larger ABCD pattern, which completes all the way down into the year-to-date lows at 68.27. Now, obviously, a move of that magnitude is likely to occur on the back of a significant upward repricing of US rate hike expectations. So for now, not expecting that we see that move materialize on the back of tonight's event, but just scoping out some of these bigger potential plays and important levels that you can keep an eye on as we progress over the year. So these are the levels I'll be looking at for the Aussie. A break of 71.40 signaling the downside break, a break of this 75 level signaling the topside break. And finally, the Kiwi then. So with the New Zealand dollar, it was a little bit disappointing actually, okay? Last week, we were stalled at this level here. We'd just broken out above that rising, above that broken bullish trend line. So we'd broken back above that level and we were currently stalled at it. We were just ahead of the Reserve Bank of New Zealand rate decision. And I was saying that if the RBNZ didn't move on rates, okay, a lot of analysts were expecting that they were going to move on rates. Actually, the majority of analysts were. So I was saying that if we didn't get that move on rates, we were likely then to see a simple breakout play higher. And the level I marked was this 70.60 level. So I was looking for a break of that level to open up and move to 72.40s. So, of course, the RBNZ didn't move on rates. They held policy at current levels. Market was taken aback by that, and we did get that initial impulse move higher. We broke out above that 70.60 level. We actually ran higher by around 80 pips, but you can see that we since stalled and reversed lower. So a little bit disappointing that we didn't get that follow through. However, I'm still confident with this chart that we're going to get a move to the top side. But the key price pivot is, of course, now still this 70.60 level, okay? So we had prior resistance, we had the initial break, we've traded back into the range, and we're now retesting it from the underside. So if we fail to break back above this level, then obviously this initial high is going to be classed as a false breakout, and we can expect a rotation lower. But that doesn't necessarily mean that we're not going to get a further move higher. And actually the move that I would be looking for is for price to trade down into this level here, so around 68.40s to 68.90s. You can see we've got this really thick band of support in the Kiwi. We've got these previous broken highs, previous lows. So we've got some really big support in the Kiwi. And for me, it still feels like the path of least resistance in this chart is to the top side, and that market is trying to move higher. So if we do rotate lower down into this level, I'll be looking for that to provide support for a continuation to the top side. And again, my target on that move will be the 72.50s, okay? Obviously below there, if we do start to move lower, the downside break is going to be this level here. So we've got these two big prior lows in the Kiwi. This was the low that signaled the failure of the bearish correction a couple of weeks ago, from which point we turned higher. It's the 50% retracement from the year-to-date lows. So if we get below this 66.70 level, then that to me signals the downside break, and we can start to look for a move down into this level. However, as I noted before, this area is so congested in the Kiwi, and flows have been so stifled each time we've tried to trade back into that zone, that I really feel like we're going to make another attempt higher. And this current expansion move is likely to now facilitate a correction lower into this level before we get a further expansion higher. So these are the key levels that I'm looking at ahead of the FOMC tonight. Going to be very interesting to see what development we get out of tonight's meeting, and I look forward to updating this analysis next week and seeing what happened. In the meantime, please feel free to head to the website www.littlefishfx.com. You can check out all of the great stuff we have there, the education, the analysis. We've also got our daily trade alerts, which we've been issuing now since November 2015, which are up over 3,000 pips. They're up over 500 pips now in June alone. So you can check those out. And we're actually holding a special event on the website later today at 3 p.m. UK time, where one of our pro traders is going to be taking a look at the methods he uses behind his specific strategy. So definitely worth checking that out. And you get a 2-week trial to the trade alert service along with that webinar. So thanks a lot, everyone. Good luck, and look forward to catching up with you all next week.